On August 13, 2025, the financial world was jolted when New York Attorney General Letitia James filed a sweeping lawsuit against Early Warning Services, the company that operates the peer-to-peer payment giant Zelle. At the heart of the case lies a shocking accusation that the platform's weak security framework allowed fraudsters to siphon away more than $1 billion from unsuspecting consumers between 2017 and 2023 for a service that marketed itself as one of the safest, fastest, and most convenient ways to move money. The allegations strike at the very core of trust in digital banking. To understand the gravity of this case, it's essential to first understand what Zelle is and why it became such a dominant force in U.S. financial transactions. Launched in 2017, Zelle was positioned as the American banking sector's answer to PayPal, Venmo, and Cash App. But unlike those platforms, Zelle was embedded directly into the apps of the nation's biggest banks. Backed by heavyweights like Bank of America, J.P. Morgan Chase, Capital One, Wells Fargo, PNC, Truist, and U.S. Bank, Zelle gained instant credibility and a massive user base. By promising instant transfers directly between bank accounts, it was marketed as a safer, more legitimate alternative to rival services. And for a while, that promise seemed to hold. Consumers flocked to Zelle, making it one of the most widely used payment apps in America. By 2022, it was processing trillions of dollars in payments annually. But beneath that glossy surface, a darker reality was taking shape, one that now finds itself in the crosshairs of one of the most high-profile lawsuits in fintech history. The lawsuit lays out a troubling pattern. Scammers quickly realized that Zelle's instant transfer feature was a goldmine. Once money was sent, it was virtually impossible to reverse the transaction. Unlike credit cards, which have robust fraud protections and chargeback rights, Zelle transfers left consumers exposed. If you were tricked, the money was gone, sometimes within seconds. Among the scams cited in the complaint are chillingly ordinary scenarios. One New Yorker received a call from someone posing as a Con Edison representative, claiming their electricity would be cut off if they didn't pay immediately. Fearing a blackout, the victim transferred $1,477 through Zelle, money that vanished instantly into a scammer's account. Another case involved a family lured into sending $2,600 to a fake breeder in a classic puppy scam. These weren't rare, isolated incidents. The Attorney General's office argues that Zelle became a breeding ground for scams, many of which followed predictable patterns. Critics point to the central flaw: Zelle was built for speed, not security. While banks proudly touted that money could move from one account to another in seconds, they neglected to build safeguards strong enough to stop criminals from exploiting the system. Multi-factor authentication was inconsistent, fraud alerts were weak, and in many cases banks outright refused to refund victims, arguing that because users had authorized the payments, even under false pretenses, they were not entitled to reimbursement. The lawsuit doesn't just target fraudsters. It targets Zelle's parent company, Early Warning Services, for knowingly failing to act. The Attorney General alleges that EWS was well aware of the vulnerabilities. Internal reports, consumer complaints, and even media investigations flagged the rising fraud epidemic. Yet the company allegedly dragged its feet on implementing meaningful solutions. Enhanced user verification, AI-driven fraud detection, stronger dispute resolution frameworks. These tools existed, but according to the lawsuit, EWS prioritized rapid growth and convenience over security. Letitia James described the consequences as catastrophic harm to millions of consumers. And she's not exaggerating. Imagine losing your rent money, your savings, or your emergency fund in a single transaction, with no way to recover it. For many Americans, these scams didn't just mean financial loss. They meant eviction notices, unpaid bills, and sleepless nights filled with anxiety. Zelle, of course, denies all wrongdoing. In response, the company has called the lawsuit politically motivated and insists that more than 99.95% of its transactions are fraud-free. It points to recent security upgrades in 2023, including basic protections like account monitoring and identity verification, as proof that it takes fraud seriously. But critics argue these changes came too little too late, after billions had already been stolen, and countless families left in financial ruin. The legal stakes are enormous. If New York prevails, Zelle could be forced to pay restitution, overhaul its entire security framework, and face strict oversight moving forward. The ripple effects could extend far beyond one company. Other peer-to-peer payment platforms like Venmo, Cash App, and PayPal are surely watching closely, because a precedent-setting ruling could redefine the obligations these companies have to protect consumers. The case also shines a light on the broader regulatory vacuum in digital finance. Unlike credit cards, which fall under well-established consumer protection laws, peer-to-peer payments exist in a gray area. For years, banks and fintech companies have argued that since consumers authorize the payments, they are responsible for the outcomes, even if they were manipulated or deceived. Consumer advocates say this logic is deeply flawed in an age where scams are becoming more sophisticated and harder to detect. Interestingly, the lawsuit comes on the heels of the Consumer Financial Protection Bureau's CFPB decision earlier in 2025 to drop its own investigation into Zelle. Under new federal leadership, the CFPB scaled back its enforcement agenda, leaving state attorneys general like Letitia James to step into the void. This highlights a growing trend. As federal regulators retreat, states are increasingly taking the lead in consumer protection cases, pushing the boundaries of how far corporate accountability can be stretched. For the legal community, the Zelle case is a fascinating study in how 20th century laws collide with 21st century technology. Should platforms like Zelle be treated more like credit card companies, forced to guarantee protection against fraud? Or should consumers shoulder the burden of verifying every transaction themselves, even in the face of professional scammers? These are the questions judges, lawyers, and policymakers must now wrestle with. But the implications don't stop there. The lawsuit could also expose the inner workings of the banking industry itself. Remember, Zelle isn't just some Silicon Valley startup. It's owned by 7 of the largest banks in America. If the case uncovers evidence that these banks knowingly allowed fraud to flourish while protecting their bottom line, it could trigger congressional hearings, stricter regulations, and perhaps even class action lawsuits from victims nationwide. For ordinary consumers, the case is a stark reminder to be cautious. Peer-to-peer platforms may feel as safe as your bank, but legally and structurally, they are very different. Sending money through Zelle is like handing over cash. You can't claw it back once it's gone. Fraudsters know this, and they are constantly inventing new tricks to exploit the system. So what can you do to protect yourself? Experts recommend simple but vital steps. Verify the identity of anyone you send money to. Never transfer funds to strangers or businesses that refuse other forms of payment, and be skeptical of urgent requests demanding instant action. If something feels off, it probably is. As the lawsuit unfolds, all eyes will be on the courtroom. Will New York succeed in holding Zelle accountable, reshaping the landscape of digital finance in the process? Or will the banks behind Zelle dodge responsibility, leaving consumers to continue fending for themselves in a world where money can vanish in seconds? Whatever the outcome, one thing is clear. This case is more than a fight over $1 billion. It is a referendum on the future of consumer protection in the digital age. In a time when money moves faster than ever, the question is whether the law can keep up, or whether ordinary people will continue to pay the price for corporate negligence. For lawyers, policymakers, and consumers alike, this is one of the defining financial lawsuits of our era. And as developments unfold, it could very well set the standard for how America handles the next generation of digital fraud. Stay tuned, because this case is far from over, and the verdict could reshape the way we all send, spend, and safeguard our money in the years to come.